Japan is widely recognized as one of the United States' most steadfast allies, a bond that stretches across economic, military, and political realms. However, there's another fascinating layer to their relationship: debt. The United States is infamous for being one of the world's largest holders of government debt. And surprisingly, Japan stands as its single largest foreign creditor. Let's dive into this intriguing dynamic and explore why Japan holds such a massive amount of U.S. debt. The staggering numbers Japan's hold on U.S. debt. As of December 2023, Japan holds over $1.1 trillion in U.S. federal debt, far surpassing other nations. For context, China, the second largest holder, owns about $816 billion. This gap is staggering and raises an important question. Why does Japan own so much U.S. debt? Why don't other major U.S. allies like Germany or France follow suit? To unravel this, we first need to understand what U.S. debt actually is. What is U.S. debt? U.S. debt is essentially how the federal government funds its spending. It does this by issuing Treasury securities, bonds, bills, and notes that promise to pay investors a fixed interest rate over a specific period. These securities are considered one of the safest investments globally, attracting everyone from individual investors to central banks. Investors buy them to earn interest while expecting their principal to be repaid at maturity. Japan's economic miracle and trade surplus. Japan's journey to becoming the largest holder of U.S. debt is deeply tied to its economic history. After World War II, Japan experienced an economic miracle, transforming into a global powerhouse in industries like automotive, electronics, and machinery. Brands like Toyota and Sony became household names worldwide, and Japan's exports soared. This export dominance led to a phenomenon known as a trade surplus, where a country exports more than it imports, resulting in a net inflow of money. Japan consistently ran massive trade surpluses, accumulating vast amounts of foreign currency, primarily U.S. dollars, since international trade is often conducted in dollars. Notice how year after year Japan exports far more to the United States than it imports. This imbalance created a flood of dollars into Japan's economy, which needed to be put to work. Why not just stash the cash? With all this surplus, Japan couldn't simply let the money sit idle in banks. Doing so would mean missing out on potential returns. Instead, Japan turned to U.S. Treasury securities, one of the safest and most reliable investments globally. By investing in U.S. debt, Japan earns steady interest while keeping its funds in a secure, liquid form. This strategy not only preserves the value of their surplus, but also strengthens their financial ties with the U.S. The scale of Japan's investment. Let's look at the numbers. In 2004, Japan held over $689 billion in U.S. treasuries, accounting for more than 30% of all foreign-held U.S. debt. That means for every dollar of U.S. debt owned by foreign countries, Japan held more than 30 cents. Over time, these holdings only grew, solidifying Japan's role as a critical financier of U.S. government spending. The role of Japan's low domestic interest rates. Another key reason Japan invests heavily in U.S. treasuries is its ultra-low domestic interest rates. For years, Japan's interest rates have hovered near zero, and at times even dipped into negative territory. This means Japanese savers and institutions earn little to no returns on domestic investments. In contrast, U.S. treasuries have historically offered yields of 1 to 3%, making them far more attractive. For Japanese banks, pension funds, and insurance companies managing billions, even a small percentage difference in returns is significant. For instance, Japan's $1.1 trillion holdings could earn between $11 billion and $33 billion annually in interest, depending on prevailing rates. Managing the yen, a strategic move. Japan's investment in U.S. treasuries also plays a crucial role in managing its currency, the yen. As an export-driven economy, Japan benefits from a weaker yen, which makes its goods cheaper for foreign buyers, particularly Americans. When the yen strengthens too much, it hurts Japanese exporters' competitiveness. By purchasing U.S. dollars and investing them in treasuries, Japan indirectly supports the dollar's strength while keeping the yen in check. This strategy helps stabilize the currency market, ensuring Japanese exports remain competitive globally. A brief interlude. China's role. Interestingly, Japan wasn't always the largest holder of U.S. debt. China briefly overtook Japan in the mid-2010s, driven by its own trade surpluses and economic growth. However, geopolitical tensions and China's efforts to diversify away from U.S. dollar assets led to a reduction in its holdings, allowing Japan to reclaim the top spot. The future of Japan's U.S. debt holdings. While Japan's investment in U.S. Treasuries has been a cornerstone of its financial strategy, the landscape is shifting. Japan's domestic interest rates have started to rise slightly, from negative 0.1% to 0.25%, and its 10-year government bond yield has climbed to over 1.2%. These changes, though small, could influence Japan's investment decisions in the future. Additionally, as global economic dynamics evolve, Japan may explore other avenues for its surplus funds. However, for now, U.S. Treasuries remain a safe, reliable, and strategically beneficial investment for Japan. Japan's massive holdings of U.S. debt are a testament to its economic strength, strategic foresight, and deep financial ties with the United States. From its post-war economic miracle to its role as a global export leader, Japan's journey to becoming the largest foreign holder of U.S. debt is a fascinating story of trade, investment, and international cooperation. As the world economy continues to shift, Japan's relationship with U.S. debt will remain a key area to watch.